Hello, everyone. My name is David Horne, and I'm the founder of Funding Focus. I'm delighted to be with you here today at the Women's Business Club conference. So, what I'm going to do is take you through a journey that I've been on over the last 3 years, a journey that, quite frankly, has changed my life. And it's a journey that I call the fight for fairer funding. I'm going to start with some pretty bad news, some stark moves. I'm then going to move on to some better news. And then I'm going to delve deeper into why this whole issue about unfair funding to female founders exists in the world today. And then I'm going to take you through what we can do to address that, what work I've been doing, and how you can learn from that to successfully raise funding to grow your business. So all of this started about 3.5 years ago when I was speaking at an event and about fundraising for SME businesses. And after my talk, a woman came up to me and asked me a very simple question. Why is it that so little funding goes to female founders? I looked at her and I said, I have no idea, but I'll find out. And as I said, that question has changed my life. So I started digging deeper into this, and I met with certain people and I started reading the research, and eventually I decided that someone had to do something about it, because whilst the investment industry was making a few noises, and only noises, but not really anything else, nobody was looking at this from the perspective of the entrepreneurs. And so I ran an event at the London Stock Exchange in November of 2019. And one of the key things that I presented to that was the findings from a report that had been published by the British Business Bank that showed just how bad the situation is for female founders. So let me just share that with you now. So this is based on data that was researched by the British Business Bank, published in 2019. They looked at every venture capital deal in the UK in 2017. And they found that out of every pound invested, less than a penny went to all female teams. Mixed gender teams got 10p, and all male teams got 89p. Now that's shocking of its own, but when you delve further into the data, you'll see an even greater issue, and one which totally contradicts the statement made by many people in the venture capital industry that they're just not seeing deal flow from female founders. So in those all-female teams, out of all of the investments decks submitted, all female teams submitted 5% of the decks, and they got less than 1% of the funding. So that's a 1 in 5 ratio. Mixed gender teams submitted 20% of the decks and got 10% of the money. So that's a 1 in 2 ratio. And all male teams submitted 75% of the decks and got 89% of the money. That's 1.2 to 1. That is clearly not fair. Now, this data is now 5 years old. So what's the situation today? Well, I'm sorry to say that it really hasn't changed much, despite all the noise that's been made in the market. So this report here looks at the share of funding to female founders, mixed gender founders, and all male founders based on all of Europe, including the UK, in 2020 and in 2021. Now, in 2020, the situation had improved slightly, where all female teams were getting 2.4% of the funding. And yet last year, in 2021, the year that broke all records for the amount of funding that went into the venture capital sector and got invested, in Europe alone, it was more than $100 billion. Never before had that level of funding been seen before. And yet all female teams, their share of funding collapsed back to 1%. So it's unchanged from what we saw at the British Business Bank report in 2017. All female teams submitted 5% of the pitch decks and got 1% of the funding. The situation for mixed gender teams has changed a little bit. Their share of the decks has slipped a little, but their share of the money received has grown a little bit. So there is some movement of some sign of positive movement for mixed gender teams. And then all male teams are still getting a disproportionate share. So 83% in 2020, 85% in 2021 of the funding went to all male teams. And what's it like this year? Well, this 2022 has been a very interesting year. You know, the level of funding that's gone into venture capital has fallen back quite sharply, compared to where it was in 2021 for obvious reasons with the Ukraine war and the global economic situation, but it is still carrying on. But in Europe, we're seeing all female funding teams submitted, and this is data through August of 2022, submitted 5.2% of the pitch decks and got 1% of the funding. Mixed gender team, 17.4% of the decks and 12.1% of the funding. So even the mixed gender teams are sliding back a little bit. And the all male teams in Europe submitted 77% of the decks and got 87% of the funding. So the funding to the share of funding going to male founding teams is still on the rise. That's the situation in Europe. Let's just slide across the Atlantic and see what happened in the United States. So again, we're looking at 2020 and 2021. So all female founding teams in 2020 submitted 6.4% of the decks and got 2.2% of the funding. In 2021, it was 6.5% of the decks and they got 2% of the funding. Now, this is really interesting because that means that the statistics in the United States for the share of funding to female founders has actually fallen for 3 years in a row now. Fallen. Mixed gender teams, 12.3% in 2020, 15.6% in 2021. So seeing some growth there. But still, the men are getting more than 80% of the funding. And again, if we look at the data in 2022 for the USA, all female teams submitted 6.8% of the decks, so up a little bit. But their share of the funding is still flat on 2%. Mixed gender teams submitted 18.6% of the decks, so pretty much the same level, and they got 14.8%. So it's falling back a little bit again. And the all male team submitted 17.75% of the decks and got 83% of the funding. So there's clearly an issue here. And as I say, so many of the investors that I speak to say, oh, we've got a problem with deal flow, or, oh, we're not seeing the kinds of deals, or, oh, there's not enough female founders. Rubbish. They're either deluded or they're lying, because there is plenty of evidence to show that all female and mixed gender teams are still continuing to submit significant quantities of pitch decks, and they are not being funded at the same level as all male teams. There are a number of reasons that can be talked about there, and we'll go into one area in particular. But before we do that, I just want to update you on one of the key things, which is the lack of women in the venture capital industry, which also plays a role, because oftentimes that whole fund management industry is described as being pale, male, and stale. And it's very true. So going back to that data from the British Business Bank, the report in 2019, they found that in the UK, just 13% of the senior management roles in investment teams were filled by women, and that 48% of venture capital funds didn't have any women in them. Harvard Business Review did a similar study over a much longer period of time. They looked at venture capital firms in the United States between 1990 and 2018. And they found that the percentage of female investors across that 28-year period was relatively steady on about 8%, lower than it is in the UK. Interestingly, 3/4 of US VC firms did not have ever a female member of their investment teams. So the situation on this side of the Atlantic is better in that regard than it is on the other side of the Atlantic. But in either case, there's still a long way to go, and there's still a lot of improvements that need to be made. And, you know, one of the key things that also gets talked about is, well, where's the evidence that female founders are a better investment? There is ample evidence. There was the Alison Rose review that came out in 2019, which found that the UK economy would add 10% of its GDP, £250 billion would be added to the UK economy if women started and were funded in their businesses at the same rate as men. And then there was another report published in the United States by Boston Consulting Group that looked at 400 different successfully funded firms over a period of several years. And they found that for every dollar invested, female founders generated 2.5 times as much revenue per dollar as male founders. 2.5 times as much. That's huge. And yet still the money is not flowing. So that's the bad news. And I always like to get the bad news out of the way up front, because we all know about it. You know, it's the elephant in the room. So let's acknowledge it. Let's talk about it. But now let's move on, because over the last 3 years, one of the key things I've been doing with my funding focus organization, which I founded in 2019 when I first became aware of this issue, is we've put on seminars and events and things. We've run 2 seminars live at the London Stock Exchange, and then during the lockdown period, obviously we had them online. But one of the key things that we've done is we've always featured as speakers women who have successfully raised funding to grow their business. And I've written a book called Funded Female Founders. In fact, everybody who's registered to attend the Women's Business Club conference will be getting a free electronic copy, so a PDF of the book. And I'll be at the event in Cheltenham where people can get a signed copy of the book. So I look forward to seeing people there. But one of the key things in this book is that I feature the stories of 7 different female founders who have all successfully raised money. 7 women in 7 different industries in 4 different countries. And the whole idea behind that is to show you that it's possible. And each of these women give tips and advice and share their stories. And sometimes their stories are quite emotionally challenging. And, you know, they talk quite openly about some of the challenges they faced and how they overcame them. And so I've got those in the book to really be seen as a guidepost and be seen as something that people can go back to if they're feeling down, and go back and get reassurance that, yes, it can be done. Yes, there are people who've done it. And like I say, I've got 7 different stories from 7 women in 7 different industries in 4 different countries. So it can be done. Now, one of the other big factors behind this whole problem, and based on the research that I did for the book over the last 18 months, probably the biggest contributing factor to this issue is what I call cognitive bias and gender stereotyping. And there's been a lot discussed around this. Some people know about it, some people have heard about it, some people don't know anything about it. But cognitive bias is driven by subconscious thinking, and it has an impact on how people observe and interpret and analyze whatever information their senses are taking in from the world around them. And it affects how they reach conclusions. In effect, each one of us constructs our own version of reality based on the inputs we're seeing. And my version of reality and someone else's version of reality and your version of reality may be all entirely different, even though we're getting more or less the same inputs. And that's because of the cognitive bias that's happened inside of us subconsciously. And bias starts at a very young age. Now, if we think about the nature versus nurture debate with children, newborn babies don't show any signs of cognitive bias. They simply take it in. Young children don't show any signs of cognitive bias. And yet the impact of bias starts at a very young age. There was a fascinating piece of research carried out by Lego, the Lego Toys company, and they found that young girls feel just as confident about engaging in all types of play as young boys, and yet they are held back by gender stereotypes. And those gender stereotypes are actually coming from the parents. So based on this research that Lego did, they found that parents are 5 times as likely to encourage girls over boys to engage in dance or dress-up activities, and more than 3 times as likely to do the same for cooking or baking. Adversely, parents are almost 4 times as likely to encourage boys over girls to engage in programming games and sports, and more than twice as likely to do so with coding toys. So it's something that's really pervasive throughout society, and it's going to take time for this to change. It's going to require a generational shift or two for this to really properly flow through, so that these kinds of inherent gender biases and gender stereotyping do not happen in future. And that's a really key thing for taking this forward. If we put this more into the context of the fundraising world, I'm going to refer to a study by a professor at the London Business School, Professor Dana Kanza, who did her PhD studies at Columbia University in New York. And during her research, her PhD research, her main thesis piece, she looked at every pitch done at the TechCrunch startup battles in New York City between 2010 and 2017. Every single pitch that was done, she analyzed the pitches and the Q&A sessions. And what she found was that there was no substantive difference between the way men pitched or women pitched. But where the real difference came was actually in the Q&A from the investors after their pitches. And what she found was that both male and female investors demonstrated a significant bias towards male founders who were pitching over female founders who were pitching. And it manifested itself through a different type of questioning. So male founders were 67% more likely to be asked what are called promotion questions. How are you going to double your market share? How are you going to expand your workforce? And 66% of women were more likely to be asked what are called prevention questions. How are you going to defend your market share? How are you going to stop the competition from stealing your employees? How are you going to protect the business? Men were asked about growth and strength of cash flow, and women were asked about margins and loss making. And it was just very, very strong and very, very stark to see that this bias was happening so consistently across a 7-year period, across thousands of pitches. And as I said, that female investors showed the same bias as male investors. So there's a fantastic TEDx talk by Professor Kanza. If you look it up, I think it's called The Real Reason Women Don't Get Funding, or something to that effect, but really, really excellent piece of research. So we've looked at how bad it is. We've talked about the fact that there are women who have done it, and there are many of them, and hopefully some of you are watching us, and hopefully some of you will be in the audience and in attendance. So there is a glimmer of hope. There is opportunity. There is a chance. And then we've seen the Dana Kanza research that helps to explain why. One of the other key things that came out of the Dana Kanza research was that women who were asked prevention questions and answered with promotion style responses were 14 times more likely to secure funding than if they answered with a prevention question. So it's kind of like the politicians, you know, they're asked a question and they don't answer the question, they put their message across. So if you find yourself in a pitching situation and you're getting a question from an investor that you identify is a prevention kind of question, take a moment and think about a promotion response to that question, because you're going to be significantly more likely to secure investment for your business. So now what I'd like to talk about is raising funding for your business. And I'm going to go through a number of different things. We're going to talk about, the first question is, do you really want to raise money? And that's a serious question. The second question is, what kind of a business are you running? And then we're going to go into talking about the different types of funding that are available. And finally, we're going to look at having your fundraising assets ready. So this is going to be a meaty, chunky section. But it's really important that we address it. So do you really want to raise money is a serious question. And in all of the work I've done over the last 20 years, and I've raised over 120 million pounds in my career, in all of the work I've done with entrepreneurs, I have seen two types of people appear quite consistently. And for them, it's really not the right thing to be raising money. And they are what I call the equity hoarder and the frugal leader. So the equity hoarder is all about, well, this is mine. It's all mine. I own 100% of this company and nobody else can come in and nobody else can have control. And there's nothing wrong with that. There's absolutely nothing wrong with that. If you want to control 100% of what goes on in your company and control 100% of the equity, absolutely fine. But then fundraising is not for you. Plain and simple. Fundraising is not for you, because when you are raising capital, you are inviting other shareholders to come in and have a say in the business and have a say in strategy and have a say in what's going on at the board of directors level. If you're an equity hoarder and you're not willing to do that, then just don't do it. Okay? But if you're not sure, let me just give you an example. Let's say that you're running a successful business and your business is worth 3 million. And you secure a new investor who puts 2 million into the business. So the business is now worth 5 million. You own 60% and your investor owns 40%. It hasn't changed in terms of your value, but you now have someone who's going to be involved with you in strategic decision making. They're going to sit on the board of directors. They might or might not be involved in the day-to-day activities of the business, but they're with you in there now. So that's already a key step. And then let's say you want to attract and retain the services of a really, really top-notch chief technology officer. And so you offer that person options over 5% of the company. And so your share goes down from 60 to 57, and your investor's share goes down from 40 to 38, and your CTO has 5, okay? And you've got that. It's still worth, the company's still worth 5 million. Your stake's worth a little bit less, your investor's stake's worth a little bit less because you've secured the CTO. Now let's fast forward 5 years and look at the business, which has grown successfully because of the strategy that you came up with, supported by the funding from your investor and developed by your chief technology officer. Everything's gone really well. And now all of a sudden, your company is worth 10 million, not 5 million. So it's doubled in size, right? So your stake now, your 57% stake is now worth 5.7 million, right? When you started, it was worth 3, and it's now worth 5.7. So it's almost doubled. Your investor's stake is worth 3.8 million, right? They put in 2, and it's gone up to 3.8. So again, it's almost doubled. And your CTO who came in got the options, and their stake is worth 500,000. So everybody's won, because really what's happened is you've taken a pie and you've grown it. And so while your slice of the pie might not be 100%, it's less than that. In this case, it's 57%. But that 57% slice of this pie is worth twice as much as it was when it was a smaller pie that you owned all of. So that's kind of the key thing for you to get comfortable with in the context of, am I an equity hoarder or not? And if you're sitting on the fence and aren't sure, that's an important thing just to think about. The other thing that I want to talk about is the frugal leader. And this is something I often see in companies that are bootstrapped, where everything that has been achieved to date has been funded by the founder and or by sales that you've been able to make in the business. And so the founder has had to be frugal because the level of money coming into the business is constrained. And so you've got to be really careful with your costs. And I completely understand and accept that. And it's an entirely legitimate strategy to follow when you're in a bootstrapping phase. But if you're going to secure money, you need to change your mindset, not into one that spends recklessly, because that's not what it's all about. And that's certainly not what your investors are going to want. But you need to open your mind to the idea that the reason you're securing funding is to actually go out and spend money and to spend it wisely in line with a strategy that's been agreed. And I've seen too many founders who, they come along and they raise the money and they'll spend some of it here and then they'll think, oh, no, wait a minute, we got to hold something back. And I've seen this many, many times when they're holding back. And the whole idea when you're raising capital is that you have that money. You can now go out and, you can go and secure the services of a super chief technology officer or chief financial officer or chief operating officer or a super marketing team or whatever it is that your business needs, you have the funding to go out and get the best that you can, as opposed to thinking, how can I get by on as little as possible? So you just need to open your mind to that. And again, doesn't apply to everyone, but I've seen a lot of people going through this process who are frugal leaders, and it's important just to get over that. Okay. The next thing to consider is, what kind of a business are you running? And I break this down into 4 different types. I call them the solopreneur, the lifestyle business, the growth business, and the large business. So the solopreneur is what many, many companies are around the world, where it's one person and, they might have a little bit of outsourced admin and accounting and other bits and pieces, but basically it's one person doing their thing, going out into the world and making their difference, but it's just them. If you're a solopreneur, great, all the very best to you, but it's very difficult for solopreneurs to secure any kind of funding other than debt, where they would then probably have to provide a guarantee on that debt so that if it goes bad, their personal assets are at stake. In terms of equity funding, in terms of raising money from external investors, as a solopreneur, very, very difficult, because all of the risk is on you. And it's just a really challenging thing. And from an investor's perspective, there's a lack of security, and they're going to be very concerned about that. So if you're a solopreneur and you want to go out and raise funding, you need to build a small team around you so that there's more than just you in the business. If you're a solopreneur and it's going well, fantastic, keep going, but you won't secure equity funding. Then there's the lifestyle business, and these are often very, very successful businesses, but they are designed around a particular lifestyle that the founder wants to have, or maybe there's 2 or 3 founders in the team, and they're very happy and they can make a lot of money, and they can be very, very successful as companies. But what they find is they're running the company to support their lifestyle. They're not running the company to grow it. They're not running the company to make significant changes in it. They're running the company to support their lifestyle. It's generating the kind of money they want. It's generating the kind of time they want for their freedom, etc. So that's, again, a very difficult area if you're seeking funding, because investors aren't going to want to come in and fund somebody else's lifestyle. Which takes us on to growth businesses. And this is where investors are absolutely interested, because they are looking at, what can I do to put my money, my expertise, my networks, my contacts in to support this company to grow it over time, so that in 3, 5, 7, 10 years, there's a significant payback. There's a significant return on my investment. And it's those growth companies that are really the sweet spot for venture capital, angel, investment type of funding. So if you are looking to achieve a situation where you've got funding coming in, you need to be having it in your mind very clear that you are a growth company. And finally, there are large companies, and these are often companies that have been set up by entrepreneurs one day, and they've moved on, and perhaps it might not have passed on to the next generation or whatever, and external management has come in. And most of the large companies that we see in the world around us today, were started by founders, but grew to a point where the founder eventually exited the business and a professional management team came in. The professional management team often don't have more than 1 or 2% of the equity, because most of the equity is funded through external investment. So obviously those kinds of companies also have access to significant pools of capital from private equity or even from public markets for those who go on and do an IPO. But in terms of going after funding for entrepreneurial businesses, your sweet spot is growth, because your investors are looking for a return. So you need to be a growth business. You need to be not looking at an equity hoarder. You need to be not looking at being a frugal leader, but being a growth business with a growth mindset, and you're bringing in the capital to achieve what you want to do with your business. So then let's move on to funding. Just let me take a sip of tea for a sec. So let's just move on to funding, and I'm just going to do a quick counter through different types of funding, because there are a lot of different types of funding. And there's grant funding, which is often linked to scientific research. That's not really my area of expertise, but I just wanted to flag it up that there are grant funding programs available out there. So if you are looking at funding, if you're a scientific or a technology or an R&D type business, you can secure grant funding. But my area of expertise is more debt and equity funding. So let's just touch on debt first. And the reason I touch on debt is because it's different from equity funding. So the key thing about debt is that's money that's being put into your business that the lender is expecting to be paid back over a fixed period of time with interest. So if you go out and borrow 100,000 over a 5-year period, you're going to be making those payments. I mean, 100,000 over 5 years is 20,000 a year plus interest costs. You're probably going to be repaying something in the order of 2,000 a month to pay that money back, so that at the end of the loan period, that loan is gone. The lender has got all their money back, has got their interest back, and you carry on with the business. There's been no dilution of your equity, but you've had to generate sufficient cash flow to pay that money back. And you have to do that pretty much from day one. Occasionally, you can get a 1-year repayment holiday or something like that, but then it makes the future repayments a little higher. So debt is all about bringing money in now. There's no dilution in equity, and then the money gets paid back over the term of the loan. But that's not just it. There are often other conditions attached to debt funding, and they're called covenants, which is loan speak for promises that you make. And there are both negative covenants and positive covenants. Negative covenants are things you mustn't do. So, for instance, you mustn't change the nature of the trade that you're doing. You mustn't declare any dividends without the approval of the lenders. You mustn't dispose of or close down any material portions of the company. And then there are positive covenants, which are things that you must do. So you must submit to the lenders every quarter financial statements. You must submit to the lenders every year audited accounts within a certain time frame. You must comply with certain ratios in the business. And these are all things that you have to do and have to follow. And it's very, very important that you do that so that you don't fall into what's called a breach in the loan, because that can really affect your credit rating and the cost of the debt will go up significantly. So debt funding is great, but you've got to be aware not just of the repayments, but also the other obligations that are on you under those covenants. So that's debt. Now we'll move on to equity. And equity is where people are buying a stake in your limited company. So you own the shares in your company, and new money is going to come in. New shares are going to be issued out to those investors, and they are going to have a percentage stake in the business. And so if someone comes in and invests and puts 40% of, what becomes 40% of the value of the company, then they are entitled to 40% of any dividends that get paid. They are entitled to 40% of the distribution of any capital, or if there's a sale, they're entitled to 40% of the capital that comes in on the deal. Different types of funding. So we'll start with individual funding. So we've touched on bootstrapping already. That's where you, the founder, put your money in, and then basically whatever you can generate in sales, that forms the cash that's available in the business to spend. Let's take it up a level, and the next most common thing is what's called friends and family. So, the bank of mom and dad, as it were. But, go around and talk to members of your family, aunts and uncles, brothers and sisters. Who do you know? Who amongst your friends? And you might often be able to find 10 or 15 friends who can pull together, maybe 50,000 or 100,000 to help you get your business off the ground and to the next stage. And that's a really important phase. And it's that's the most friendly group of shareholders you're going to have, because yeah, sure, they're investors in your company, but they're also from your community. They're your fans. They're your closest followers. So many founders often raise that kind of money as their first external funding from friends and family, because it's a little bit easier. On the other hand, some people find that really difficult. They find it hard to go out and approach people who are in their close network, their parents, their brothers and sisters, their friends, and ask for money. And a lot of people sort of have this kind of sense of, oh, well, it's almost like asking for charity. It's not. You're not asking for charity. you are offering people a stake in your company. You are offering people the opportunity to buy a share in the business and have that share and be able to benefit from that in the future through the growth that you, the founder, are driving with your team. So it's important that you're comfortable about that. And you know, many people at first, it feels a bit weird, but go ahead and ask. It's okay. You know, the worst thing that'll happen is somebody says no. The next level beyond friends and family is what's called crowdfunding. And that's something that's really taken off in the last 5 to 10 years. Often driven by technology. Also, there's a less burdensome level of regulation on companies because there used to be very strict rules about who you can and cannot approach for funding. But crowdfunding, and there are a number of platforms. There's Kickstarter, there's Crowdcube, there's loads of them. Just Google crowdfunding near me, and you'll find a whole range of sites that offer crowdfunding options. And basically, crowdfunding is a wide community of individuals and some institutional investors who put money into small startup businesses who are doing what's often one of their first, or if they've done friends and family, then their second kind of external raise. And oftentimes, you know, the individual investments might be small. They might be 10 or 100 or 1,000, 10,000, something like that. But by accessing a wide group of people, by accessing the crowd, you know, if you get 10,000 people who put in 100, well, you've raised $1 million right there. And, you know, that's the whole appeal of the crowd and the whole crowdfunding movement. So it's definitely an area that many companies should look into. It's still competitive. It's still a challenge. There's no guarantee that you're going to get it. But if you get through the processes, and the crowdfunding companies have a number of very interesting vetting stages and processes that you have to get through before you get access to their crowd. But if you can get through that, it's often a very useful way of raising money. Now we're going to move on to what's often referred to as more professional money. But we're going to stick with individuals first, and those individuals are called angels. And many times angels are successful business people who've had their own exit, made their own money. They've decided they don't want to run another company, but they want to take their money and invest in other businesses to support them, to guide them so that they can benefit, those businesses can benefit from the angel investor's own experience, and you know, really kind of keep that whole ecosystem of entrepreneurial businesses going. And angel investors often operate in what's called a syndicate. So there might be a group of 10, 15, 20 of them. In order to get into that, you need to find who's the gatekeeper, because there's always a gatekeeper in one of those syndicates. Who's the gatekeeper, and how do you get to that person to get through so that you can actually pitch to make the investment? So this is where you need to start doing your research a little bit more, finding out who these people are, getting introductions to them, meeting them, you know, go to networking events, go to angel investing events. If you're interested in angel investing, there's different angel organizations all around the world. Again, just wherever you are, just Google angel investor networks, and you'll find a range of things that you can do to get more information or go to events or meet these kinds of people. And then finally, we're going to move into what's called institutional money. And the big change here, there's a couple of changes here. Number one, the amounts of money that we're talking about all of a sudden are really shooting up. And number two, and this is one of the keys, is institutional money is managed by professional investors. So these are people, all they do, their whole job is managing money and raising and investing that money. And what you got to look at with institutional investors is it's not their own money that they're investing. It's money that's come in from people that they've secured funding from, right? And they're often referred to as limited partners. Now, the people that you'll meet in the venture capital funds oftentimes will put some of their own money into a deal as well, or put some of their own money into a pool that gets allocated to the various deals. But this is other people's money that they are managing. Venture capital and private equity, absolutely, it's other people's money. And then the third sector of institutional money is family offices. That might, in some cases, be the family's own money if the family is running its own office. But many times wealthy families entrust their money to family office companies. So again, the people who are running the money on a day-to-day basis are not the people whose money it is. It's institutional money. So the level goes up, it gets a little bit harder. Reaching these people is tricky. Getting in front of them is tricky. They're going to be much tougher when you're pitching to them. They're going to be much tougher on their negotiations. But they're the different kinds of people you can approach. So just to recap that, because this has been a long section. So initially we had debt funding, which is where you borrow money and you pay it back. And then we moved on to equity, which is where people buy a stake in your company. There is no expectation that they will get that money back from you, the company. They will get that money back when the company has what's referred to as a liquidity event, where there's a sale or someone comes in and makes a new strategic investment or whatever, but there is no requirement on the company to pay that money back when it's equity. And we talked about bootstrapping, friends and family, crowdfunding, angel investors, venture capital, private equity, and family offices. There's a lot to cover. It's all explained in much more detail in my book, so please do have a look at that. So let's say you're now at the stage where you're ready to go out and raise. The key thing you've got to do first up is you need to have your fundraising assets ready. And there are a number of different things you have. You need to have a clear business plan. So what is it that you're going to do? What is the strategic aim? What are the challenges? What are the things you got to do? You have to have that clear and you have to have it documented. It's not enough to have it in your head. You've got to have it documented as a business plan. You've got to have financial projections. And I know it's crazy because you don't know where it's going to go, but you've got to have an idea of where you're going to go. And those financial projections need to go out for 5 years. If you don't have anyone in finance in your team, find someone that you can bring in to help you put those projections together, because I promise you, you will not raise funding if you don't have solid financial projections in place. And then there's the pitch deck. And I've done a lot of work with pitch decks over the last 15, 20 years. And I've seen so many different ones, and some of them are amazing, and some of them are appallingly bad, and some of them are okay, and some of them have some good things and some bad things. And taking all of that kind of experience, what I've got now and what I do with my team when we're engaged to help someone produce a pitch deck is we come up with 12 core slides. That's it, 12. You don't need decks with 50 or 100 pages. In fact, please don't do them because they won't get read, but 12 core slides. And I'll just take you through them one by one. So you got a cover slide. Here it is. Some kind of an image of your company, investor presentation. That's it. Just make it really clear, make it attractive. Next, you've got an elevator pitch. In 30 seconds or less, what is the message? What is the point that you're trying to get across? Because what you got to realize is each time the investor opens up a deck, and they get loads of decks, they get loads and loads. I know of one VC firm in London that in 2021 received over 8,000 applications for funding. So you gotta catch their attention fast. So get that elevator pitch in 30 seconds or less, because oftentimes that's it. If they're not caught by the 30 seconds, they don't even bother looking at the rest of the deck. So get your elevator pitch nailed. Next slide, and this is especially important for earlier stage companies. Next slide, slide 3, is the team. Because more than anything else, the investors are investing in people. Do I know these people? Do I like them? Do I trust them? Do they know what they're doing? Do they know what they're talking about? Are they coming together as a cohesive team? So right up front, I want to see that team. And when the pitch is actually happening, I'm going to want to know more about what's going on with the team. So slide 3 is the team. Really, really important. Slide 4, the problem. What is the problem that you're out there discovering and trying to do something about? And then obviously slide 5 is the solution. So pardon me, slide 4 is the problem. Slide 5 is the solution. Problem says this is an issue in the market. Solution says this is how we address the issue. Just and make sure that your solution specifically addresses your problem. Next slide, traction. Where are you at? What kind of proof have you got? What kind of evidence have you got in the market that this is working? Have you got a prototype? Have you got a minimum viable product? Have you got customers? Have you got interest from the media? Have you got coverage in the media about what you're doing? Have you secured any contracts? Are you in discussions with potential partners about partnership deals? Are you, where are you at in very concrete terms that shows evidence in the marketplace of what you're doing? That's the traction slide. And it's really, really important because investors want to see some degree of traction. They will understand at various stages of a company's life, you're going to have different levels of traction. So if you're a brand new startup, you're not going to have revenue. That's okay. Just focus on the investors who are comfortable in pre-revenue startups and then tell them what things you've got in place that show evidence in the market. If you have got customers, how many of them? What's their monthly spend? What level of customer retention have you got? What's your churn rate? All of those kind of features. Those are the important pieces of traction. Next slide is your target market. And investors like to see this presented in 3 sets of figures. They're called TAM, SAM, and SOM. TAM is the total addressable market. SAM is the serviceable addressable market. And SOM is the serviceable obtainable market. So let's just take an example of a coffee shop, okay? So the total addressable market is every high street in the world, because every high street in the world has a coffee shop, and that's where we are. The serviceable addressable market might be every high street in your town or city where you live, or every high street within a 20-mile radius of where you're based, but something much, much smaller, but that's attainable, addressable for you. And then your serviceable obtainable market will be the smallest of those. And that's really what's the share that you can get. Right, it's on this street, and it's on this street, and it's in this shopping center. And that's where my locations are going to be. So I'm going to be able to attract the footfall to have people come into my coffee shop from those different markets. So you want to, the total addressable market is the great big one. The serviceable addressable market is much, much smaller, but that you can still potentially reach. And then the serviceable obtainable market is the market that you're actually going for. And that's what you're initially focusing on. But the investors want to see those bigger numbers, because if you're successful in addressing their serviceable obtainable market, then maybe there's room for another expansion round that will take you onto a bigger market and a bigger market and a bigger market. Because this is all about growth. This is all about achieving a bigger slice of the pie. It's all about making that pie bigger and bigger. So you need to have those 3 stats. Then competition. So who else is doing this? And I find a lot of founders who think, oh, well, I don't really, my thing is unique. I don't have any competition. For an investor, that's not a good thing. If you don't have any competition, that says, why has nobody else come up with this idea? Why is nobody else trying it? So investors like competition. And actually, founders should like competition too, because it always keeps you on your toes. And there's someone else who's out there going after the similar set of customers as you are. Maybe if you've got something really that's truly, scientifically unique, there might not be a lot of competitors. Or, maybe there's only one, but they're in another part of the world or something like that. But don't underplay the competition side, because the fact that there's competition means there's a market, and if there's a market, then it's worth going for. So be clear and be honest on your competition. Next one is your financials, and like I said at the beginning, you've got to have 5 years of financial forecasts. What actually goes into your pitch deck is a very high-level summary. In fact, what I often do with clients is I put in 3 charts. Here's our revenue chart. Here's our profit chart. Here's our cash flow chart. And that in one slide very quickly demonstrates, okay, these are the kind of growth trajectories. These are the kind of things that we can expect to achieve. This is what we can do to grow this business. And this is where your funding, Mr. or Mrs. Investor, is coming in and is going to help us achieve. So you've got to get those in place and make sure that they're attractive, because investors are looking for a return. Next up is your investment ask and your exit plan. So if you're looking for $1 million, say upfront, I'm looking for $1 million, and my plan is to exit in 5 years' time by selling into a bigger coffee chain group, or selling into a new supermarket, or going to a private equity roll-up group, what are you going to do that's going to lead to an exit that's going to enable your equity investors to see money come back? That's really critical. So how much are you looking for? And what's that golden thing that you're aiming for that will see the investors get their return? Second to last slide, really, really important, use of funds. What are you going to do with the money? If you're raising $1 million, set out clearly, 350,000 is going to be on this, 250,000 is going to be on this. Make it clear so that the investor knows exactly what you're going to be spending that money on. Absolutely critical. And then the final slide, thank you and contact details. Thank them for their attention. And here's how you can reach us. And that's it, 12 slides. If you need to add one or two more because you've got something unique about your business, some kind of fancy technology or scientific thing or whatever, okay, one or two more. But please don't do a deck more than 15 slides long. It won't get looked at. Honestly, it won't. Okay, so you've got all your assets now. You've got your business plan, you got your financial projections, you got your 12-page slide deck. Now you got to research and approach investors. And this is just as important as the rest of the stages. So take the time, and there's lots of sources out there. You can look at things like Crunchbase, you can look at things like angel.co. There's a whole bunch of different sources where you can find out about investors. You can go onto LinkedIn, you can go onto Twitter, start following them, start engaging with them, start building a relationship with them before you need the money. So that when you're actually at the point where you're going to be going and pitching to get money, or well, you're going to be approaching them to get invited to pitch to them, there's already some kind of a relationship. Maybe what you do is, let's say you find a particular VC that's absolutely spot on for what you're looking for the kind of company you are, etc. So then what you do is you go onto their website and have a look at who else they've invested in. And many, many times they'll list out, these are the companies that we've invested in. So reach out to those companies. Go and talk to the founders of those companies. Say, hey, I notice you're backed by XYZ company. I'm looking at something like that. They're really interesting. Can you tell me about them? And many times founders will be very happy to share that, very open with that. And if you build that rapport with another founder and get that relationship going, then when you're ready, you can say, well, hey, could you introduce me to so-and-so at firm XYZ? Because a warm introduction from someone they know is still the best way to get into these things and get an investment opportunity. Coming back to that example I gave of the London VC, they had 8,000 applicants, and I know that they only made 16 investments in that year. So you want to maximize your chance. So don't just, shotgun your pitch deck out to 1,000 VCs that you got from some free list on the internet, but actually go in and do the research and find the VCs that are appropriate to you, that focus on you, that are looking at your type of business, that are looking at your industry, that are looking at your stage. Are you pure startup? Are you seed? Are you pre-revenue? Where are you at? And find the investors who are looking for that, because the investors who aren't looking for that, your deck's going to get 30 seconds and it's gone. So it's a waste of everyone's time. Pitching. So you've got through the process and you've been invited to pitch. And this is one of the things that I find a lot of founders really struggle with. I like to break this down and keep it quite simple. And I say the goal of a pitch is to get to the next stage, whatever the next stage is. So when you are invited to that first pitch, just stop and think for a moment. You've made it through their vetting process. They've said, okay, this one looks interesting. Pardon me. What are they looking for? They're looking for fit. They're looking for chemistry. Do I like these people? Could I spend time with them? Because once you get into that equity relationship, it gets very close, very tight, and at times can be a very challenging relationship. So what is it that's the next stage? And if it's your first pitch going in, stick to your 12 slides and just tell the story, tell it honestly, tell it with heart, tell it with emotion. I know founders will always do that, but don't be afraid to do that, to share that, to make yourself vulnerable as a human being to connect with another human being. Because I know there's all sorts of horror stories about investors, but they're human beings too. So you're trying to establish rapport. You're trying to establish a relationship. You're trying to establish trust. You're trying to establish, are these the kind of people I can work with? And don't forget that it's also a two-way street. Your job, in addition to pitching your company, is to assess, what are these people like? What are these people going to be like when, one of the inevitable bumps in the road happens? What are these people going to be like when we miss our revenue forecasts? What are these people going to be like when a new product development doesn't work? Because bad news will happen along the road. And you need to assess how these people are going to respond. You need to assess, am I going to be okay with these people? As one of the ladies who features in my book says, your early stage investors can be your biggest supporters, and they can also be the biggest anchor that holds you back. So don't just rush in when you've got that. Remember, it's a two-way street. But that first pitch, the goal is all about fit and chemistry. Okay. And then once you get invited back, then there will be another one. So if you're successful in that first pitch, they're going to invite you back to another one where they're going to say, right, we're going to bring in our financial experts and we're going to go all over your numbers. So you need to be ready for that. Or they might say, right, next pitch, we're going to bring in our technology expert and he or she is going to go crawl all over your code. Fine, be ready for that. Know what that is. Know what it is at each stage. But that first one is all about just telling that story in the 12 slides and establishing, is there a fit? Is there chemistry? Can we work together? And then finally, there's negotiating the deal. Now, I could probably talk for another hour about that because it's a complex area. What I will say is when you get to this stage, you must have professional advisors with you. They don't have to be with you in the room all the time, but when you're actually sitting down and hashing through the points, you need to make sure that your lawyers and your accountants see that information, see those documents, and they'll be skilled in dealing with that and will know what to do. Make sure, by the way, that you might just have a local lawyer or accountant who's never done this kind of thing before. Fine to keep those people on as your local advisors for what you're doing, but when you're getting into something like this, you need lawyers and accountants who understand deal making, who understand this process, and who've done it many, many times before. So please, when you're getting down to negotiation, have the right professional advisors. It's absolutely critical. It's probably the most important step because if you don't, you'll miss stuff in the sale and purchase agreement or in the investment agreement or in the shareholders agreement where if you weren't aware of it and all of a sudden something happens and it triggers this particular thing, bad things can happen. So get professional advice. Okay, we've covered an awful lot of material. I'd just like to quickly recap everything. So we started off, we talked about what it's really like out there. We talked about the frightful state of the statistics. Then I told you about the 7 women in the 7 industries in 4 different countries. So, evidence that there is possibility. There are people who can do it. We talked about cognitive bias and gender stereotyping. And then we had a big chunky section all about raising money. So do you really want to raise money? What kind of business are you running? What are the different types of funding? And then we talked at some length about your fundraising assets. We've talked about researching and approaching investors. We've talked about pitching. We've talked about negotiating the deal. It's a lot to watch. Fortunately, it's going to be available online, so you can come back and see it again. But just to close it out and to point you at some further resources if you want to know some more. So number 1, my book, Funded Female Founders. It was published in June of this year. Everyone who is registered to attend the conference will be getting a PDF version of the book. I will also be at the live event in Cheltenham. I will have books available at a discounted price for sale, and I'm happy to sign them for you. So please do check out the book. Number 2, I have a TEDx talk called The Fight for Fairer Funding. So if you just go onto YouTube and type in The Fight for Fairer Funding, you can see my TEDx talk. And that kind of gives you a bit more of the backstory of how this whole journey for me began and where it's going. And number 3, please do go on and register on our website. It's www.funding-focus.com. www.fundingfocus.com. So the company is Funding Focus, and the website is www.funding-focus.com. And finally, in closing, I just want to let you know that I am currently working with a team of 5 women and 1 other man on the launch of a new investment fund that we are aiming to get away in November of this year. It's going to be a little bit different than many of the investment funds because it's going to be listed on the London Stock Exchange. It's going to be a public company. And that's a deliberate strategic decision that our board took, because far too much of what goes on in the venture capital and private equity world is private, opaque, and almost impossible to make your way through. And so we want to bring transparency to the market. We want to bring transparency about how this works, about what happens, and it'll involve the ups and the downs. And you know, we're completely open to that. We know that, but we feel it's really important to drive transparency. And the other key thing is, and again, once you've seen my various things on the website, on my TEDx, on my book, I am speaking regularly about this subject. Having a public company will give me a platform that enables me to spread that message further, because I am committed to doing everything I can to level a very uneven playing field. So thank you very much for your attention. It's been lovely spending this time with you. And if you're in Cheltenham, please come by and say hello. And for the rest of you, yeah, you've got my contact details. You can find them in the book. You can find me online. You can find me on LinkedIn. And I look forward to helping you and seeing where it goes from here. So thank you so much and have a wonderful day. Bye-bye.